So when you first glance at MSC Industrial's latest earnings report, you might just see bad news, right? A classic miss on Wall Street's expectations. But what if I told you that miss wasn't a mistake at all? What if it was actually part of a much bigger, much more ambitious plan? Yeah, that's what we're going to dig into.
Okay, so first things first, who is MSC? For anyone who needs a quick refresher, they're a huge player in the industrial world. We're talking a leading distributor in North America for, well, pretty much everything, from metalworking tools to all the stuff you need for maintenance and repairs. Basically, these are the folks who keep our factories and workshops humming along.
And that really brings us right to the heart of it, doesn't it? The big question we're trying to answer here is, was that sales miss a red flag, a sign of trouble? Or was it something else entirely? Maybe even the predictable, totally intentional outcome of a huge strategic gamble.
All right, let's start with the headline numbers, the stuff that gets all the attention. When MSC dropped their Q2 results, well, let's just say they didn't quite line up with what the analysts were hoping to see. So what did they actually bring in? Revenue for the quarter was just under $918 million. I mean, that's a massive number by any standard. But the real story here isn't just the number itself. It's how it stacks up against what everyone thought it would be. See, Wall Street was looking for something closer to $932 million. That's a difference of about $14 million bucks. Now, in the grand scheme of things, maybe not a catastrophe, but it's for sure a gap you're going to notice. And hey, it wasn't just revenue. They also came in a couple of cents shy on their adjusted earnings per share. So when you look at the two big metrics that all the analysts are watching, revenue and earnings, it was a miss on both fronts. Now, usually, that's where the story ends, a bad quarter. But not this time.
To really get what's going on, we have to look under the hood. We need to go past those surface-level numbers and see what was happening inside the company's engine room. Because, believe me, they were in the middle of a massive overhaul.
And you know, the CEO, Martina McIsaac, she came right out and said it. She wasn't making excuses. She basically said, yeah, our results took a hit, but it was because of something specific we did, something that had to be done. They knew it was going to hurt a little, and they went for it anyway.
So what was this big, painful action? A complete and total reorganization of their sales force. Just try to picture this. You're a customer, and you've got maybe 2, 3, sometimes even 5 different people from MSC calling on you. Can you imagine how confusing that would be? It was inefficient, it was a mess, and it was costing them money. So they decided to just rip the whole system out by the roots.
They broke it down into 4 main steps. First, they had to find all that messy overlap. Then, they started consolidating teams, moving to a much cleaner model based on geography. The goal? Give each customer one single person to talk to. Simple. And yeah, this was a big move. It meant reducing their headcount, impacting about 130 people. We're talking major surgery here, not just slapping on a Band-Aid.
Okay, so MSC knew there'd be some disruption. They planned for it. But then a few curveballs got thrown their way that made things even tougher. You had bad weather, I mean literally freezing conditions, that delayed reps from meeting their new clients. Then, more employees left than they expected, which, whoops, left some customers with no one to talk to for a bit. And to top it all off, a partial government shutdown. It was pretty much a perfect storm for a dip in sales.
But this is where the story takes a really interesting turn. Because while all that chaos was hitting their sales numbers, something else, something really positive, was happening to their bottom line. Believe it or not, they were actually becoming more profitable.
This chart right here, this tells the other half of the story. Take a look at the adjusted operating margin. That's a super important way to measure how profitable the core business is. It jumped from 7.1% last year to 7.5% this quarter. That is a huge leap in efficiency, especially for a company this big. So think about that. Sales were down, but their ability to make a profit on those sales was way up.
And how'd they manage that? Simple. They did exactly what that big, painful reorg was supposed to do. They took permanent costs out of the business. That dip in sales, that was the price of admission. It was the calculated cost of becoming a leaner, meaner, more efficient company for the long haul. And it wasn't just about cutting operational costs either. Check this out. Their gross margin, basically the profit they make on every single dollar of product they sell, also went up, hitting 41.1%. That was even better than expected. It just goes to show they were getting smarter about their pricing and their costs, even while all this other chaos was going on.
So you could say they ripped off the Band-Aid in the second quarter. They took their medicine. So what now? What does the future hold? Well, if you look at the company's forecast, they're sending a pretty clear signal. The worst is over. It's all in the rearview mirror now.
And this really shows you the kind of turnaround they're banking on. After growing just 2.9% in that super messy Q2, look what they're forecasting for Q3, a jump to between 5 and 7% growth. That's not just bouncing back, that's hitting the accelerator.
And look, this isn't just them being optimistic. They're already seeing proof it's working. The green shoots, as they say. Their main customers are already starting to buy more. And those big national accounts that took the biggest hit, they're already bouncing back. They grew in the mid-single digits just last month. It's like the new, leaner sales structure is finally starting to fire on all cylinders.
So the CEO is pretty much saying, look, we've gone through the tough part. Now get ready for the payoff. They feel really confident that both sales and profits are only going to get stronger from here, all because of those changes that caused the pain in the first place.
All right, so let's put all the pieces of the puzzle together. What's the big picture here? What's the real takeaway from an earnings report that seems to be sending so many mixed signals?
It really comes down to this. MSC made a really tough but very deliberate choice. They decided to take the hit. They traded one bad quarter, one negative headline, for what they're betting will be a much stronger, more profitable, and healthier company for the long run.
And that leaves us with the million-dollar question, doesn't it? In an economy that's anything but certain, pulling off this kind of massive internal change is a seriously bold move. It's a huge, calculated risk. Yeah, the early signs look good, but the real test is still ahead. So, will this big bet actually pay off? Well, that's the story we're all going to be watching.